Hi, I'm Ira Koyner, the original IRA and president of Triathlon Partners. Charitable giving isn't just about writing a check. With some planning, you can support the causes you care about while also reducing your tax bill. And with tax laws changing in 2026, the timing of your gift has never been more important. Plan carefully in 2025, and you can lock in bigger deductions and make an even greater impact with the same dollars. One of the simplest and most effective strategies is donating appreciated stock you've held longer than 1 year. When you donate stock directly, you get a deduction for the full market value, and you avoid capital gains tax, meaning your favorite charity ends up with more money than if you sold the stock first and gave the cash. I've included a link in the description to a webpage that shows the side-by-side numbers so you can see exactly how donating stock directly makes your gift go further. Now, the easiest way to donate stock is often through a donor-advised fund, or DAF. A DAF sounds complicated, but it's really very simple. You make a contribution into the fund, and you get the full tax deduction for that year, the year you contribute. Then you decide when to recommend grants to your favorite charities. You can do all at once or spread it out over time. You can even invest the balance for potential growth. Here's why this matters in 2025. Because starting in 2026, the first 0.5% of your income won't be deductible, and higher earners may see their deductions valued at lower brackets. That's why bunching several years of donations into a DAF in 2025 makes sense. You lock in the bigger deduction now while retaining full flexibility to give on your own timeline. Now, for retirees, one of the most powerful tools is the Qualified Charitable Distribution, or QCD. If you're 70 and a half or older, you can transfer money directly from your IRA to a charity. It counts towards your required minimum distribution, but it doesn't show up as taxable income, keeping your Medicare premiums down and your bracket lower. And unlike most strategies, QCDs aren't affected by the 2026 tax changes. In fact, for retirees taking distributions, QCDs will continue to be the most efficient way to give in 2026 and beyond. As 2025 winds down, timing is critical. For itemized and high earners, 2025 might be the best year to maximize deductions before they become less valuable under the 2026 rules. Larger gifts or donor-advised fund contribution this year could be worth more. For non-itemizers, it may make sense to wait until January to donate, since under new rules, you might finally get a deduction you wouldn't in 2025. For larger or more complex gifts, charitable trusts can provide additional benefits. Charitable Remainder Trust lets you receive income for life while leaving the remainder to charity. A Charitable Lead Trust gives to charity first, then transfers the remainder to your heirs. And in both cases, you receive an immediate tax deduction when the trust is created. These are advanced tools, but they can be powerful when philanthropy and estate planning work hand in hand. So here's the takeaway. 2025 is a unique window of opportunity. Donating appreciated stock and funding a donor-advised fund this year can lock in higher deductions. Retirees can continue using QCDs as the most efficient option. And for everyone, understanding how the 2026 rules will affect your filing status can make a big difference. If you'd like to see what these strategies look like for your own situation, let's schedule a conversation. We'll help you maximize both your generosity and your tax savings at Triathlon Partners. I'm Ira Koyner, the original IRA. Have a blessed day.